Good afternoon, everyone. My name is Joe Bloodgood. I'm here with my partner, Nathan Faith, and we're excited to spend the next couple of minutes with you on a topic that we think is extremely timely and extremely important. The elections are now over, and we wanted to talk for just a couple of minutes about what we think you should be thinking about in 2021 and beyond as it relates to your wealth management needs. Now that we know that Joe Biden will be the next president of the United States later this month, and it looks like the Democrats will have control of the Senate, there's a couple things that I think are worth mentioning. First, let's talk about the near term, or let's say the first 100 days. We know that the vaccine is in the process of being rolled out more broadly, and we also expect more stimulus to occur. More broadly, the Democrats have indicated that things like infrastructure, education, healthcare, housing, and green energy are going to be important, and that tax increases on certain individuals will likely be the ticket to pay for a lot of that, a lot of those changes down the road. Nate, can you share with us what some of the potential tax changes could look like?
Thanks, Joe. And yes, absolutely. In prior webinars and videos, we've spoken to many of these tax law changes. So now that we have more clarity, I want to go through a refresher of what those changes may look like, and then what you can do about those potential changes with your own personal planning. So in front of you is a graphic of the current tax landscape on the left and the proposed tax changes on the right based off of the Biden agenda. And what I want you to focus on are the two key lines in the sand that Joe Biden and his team are publicizing. The first is where the 1% that they're targeting would have their tax rates increased on ordinary income, being their salaries and business income. Now, the key observation here is the tax rate itself isn't meant to go up that much. However, it begins at a much lower level of income. Below this line, tax rates are considerably lower, and that's why it's important for you to know where these changes occur so that you can manage your income accordingly. Secondly, a major change would be how our portfolio income is taxed here in this third column. Once one's overall taxable income, which includes the income from the first column, plus the income that they earn from their portfolios, such as dividends and gains, exceeds $1 million, the federal tax rate on those profits would double from 20% to just about 40%. But below those thresholds, on the ordinary income side in column 1 and the gains and dividends in column 3, the tax rates are nearly half. And so that's where the planning can come into play, is this middle ground between these two lines when it comes to managing your income. So what you saw is an image of where we think the tax landscape is going. Now, what strategies can you consider taking now, even before the tax law changes go into effect? The overarching strategy is called tax bracket management, meaning in that first column, your ordinary income, most of our clients will want to keep their income below that red line at $400,000. And they'll want to keep their overall taxable income, which includes the income from the first column and the income from their portfolio in the third column, below $1 million. Now, how can you manage your income each year and over time to keep your long-term tax bill low? One of the most valuable strategies has to do with whether you're charitably inclined. Charitable contributions become more and more valuable as one's tax rate increases. And believe it or not, giving to charity in specific ways, such as giving appreciated stock, when tax rates are potentially as high as they're being proposed, it's really the government, through tax savings, funding much of those charitable commitments and contributions, and not you personally. In fact, it may actually become the case in which you receive more in tax savings than dollars that you actually give to charity at those very top tax rates. Then we move on to staying in between those lines, specifically with your portfolio income. Year by year, based off of your personal circumstances, you could harvest $500,000, $1 million, or even more dollars in profits from your investments without going over that top red line. And if you can do that in moderation each year over time, you can essentially cut your tax bill in half or more. And another form of tax bracket management is whenever your ordinary income, so your salary, Social Security checks, or pension checks, cumulatively is below that $400,000 line and you're in the green, that's a wonderful opportunity to take advantage of the low tax rates while they're good before your income eventually is forced out into the red area, and perform large, proactive Roth conversions by moving money from your IRAs into forever tax-free accounts. For those with significant amounts of wealth in their portfolios, I'm talking to the tune of tens of millions of dollars in taxable accounts like a brokerage account. It's often the case where your income is taxed at top rates, but you don't necessarily need the income for cash flow needs. So if that is indeed the case, why pay taxes on that income year by year if you really don't need the money for anything else? There are strategies in which you can literally move or migrate tens of millions of dollars into a tax sheltered account in which year by year, all the income and any gains that you recognize are not taxed. They're only taxed when you withdraw the profits from those accounts. By sheltering a significant amount of your wealth in these tax-deferred vehicles, one that we commonly use is called an investment-only variable annuity, which is basically a tax shelter for stocks and bond investments.
Thank you, Nate. While we don't know exactly how the landscape will change, rest assured that we'll work closely with you to help you navigate your wealth management needs in your best interest. To find out more, email us at learnmore@boullaygroup.com. Again, it's learnmore@boullaygroup.com.